The driving factors for the Russian credit market for 2017 are probably going to be the normalization of the economy. However, economic policies are going to remain relatively tight, which suggests that domestic demand will remain relatively sluggish and recover perhaps only next year, and therefore most likely be the corporate issuers that have hard currency revenues, which will be in most demand. And this will largely include sectors such as the commodity producers, but also those that have revenues indexed to dollars, such as the transportation and logistics companies. The risks for 2017 are similar to those that we saw last year, except the topics in some cases are more advanced. These include the possibilities that sanctions will be relaxed, but also the possibility that the Fed will be more active in normalizing its interest rate structure than in the past. But at the same time, we still don't know where oil prices will be at the end of the year. We don't know if the OPEC agreement will be extended for another 6 months. And we also don't know what the state will be of U.S. fiscal policy or sanctions. I think probably we will see a continuation in the increase of ruble-denominated bonds. But when I consider this and when I debate it with my colleagues, we mostly conclude that ruble financing will mainly be a loan instrument, and that the dollars will be the primary bond instrument. But at the same time, in the discussions that I've had with the Russian commercial banks over the past few months, they have suggested that the demand for dollar loans is lower than it has been in the past. So there will be more of a divide, not conclusively, but increasingly it will be when one thinks of bonds, one will think of dollars, and when one thinks of rubles, one will think of loans. Of course, this isn't a blanket statement, but I think that's probably going to be a trend we'll continue to see in evidence throughout 2017. We may see more perpetual debt issuance than we have in the past. There's a slight possibility that some corporates, along with banks, will take advantage of that. But by and large, I think we'll mostly see in the bond market more conventional issuance. And if there is a trend we might see in the second half of 2017, it's tenders for existing bonds or calls of existing bonds, and then maturity extensions, because there's a lot of debt falling due next year. I think in that case, the funding environment itself won't be quite heavily impacted. If we look at the issuance data from the past several years, whereas the primary market new issue volume is likely going to be quite high, the net new issue volume will be still quite moderate, perhaps in Russia in the order of 10 to 15 billion. So this will give all of us in the markets a lot to do, a lot to analyze, a lot of yield curve analysis to undertake. But in terms of the net new issue volume, the market will probably stay roughly the same size. To me, the issue of corporate debt in emerging markets in general has been overstated, in part because if we look at the balance sheets of the corporations, the debt and the assets tend to rise and fall with the cycles in the global economy, but also with the cycles in commodity prices. And because bonds are marked to market every day, and sometimes perhaps more frequently, then asset managers are pretty well aware of the market value of the balance sheet on quite a timely basis. And therefore, the burden sharing is a lot more widespread than when the debt is either concentrated in a relatively few number of corporations or alternatively in a relatively small number of lenders. And the more dispersion that you have and the more price discovery you have of the market value of the asset sheet, of the balance sheets of the corporations, then the safer it is overall and the less likely there's going to be a disruption or an event risk that causes a major crisis. On that point, I see two themes. First of all, I think in terms of traditional investors, we'll go back to basics. from what I can tell, the ETF investors have become a little bit less enamored of investing in emerging markets because whereas the entry and exit costs are relatively low, their ability to match or replicate the performance of the index is not as high as maybe they originally thought. In addition, because of fee compression, the hedge funds have had to cut their costs quite significantly, which means the principal investors in core emerging market debt will be the dedicated the dedicated asset managers, but also the crossover investors. And I think the time is coming for Asian investors, in large part, and also the Chinese investors in the yuan, but with one distinction, meaning that the Chinese authorities are still concerned about capital flight, and they may see significant yuan issuance as an effort to take capital outside of the country while leaving it in the local currency. So I think that will be a theme, but more likely a theme for 2018 rather than 2017.